Hello, everyone. This is a lecture on the last topic of external financing, which is about debt financing. Okay, let's jump right into it. So previously, we talked about equity financing, right, which we separate into two parts. First, private equity and public equity, right? We talk about different type of investors. We talk about the process of going through IPOs, and later on, I provide some additional information on ICOs. Right? So in this lecture, we're going to focus on the other channel, the other channel of financing, external financing, which is from borrowing. Okay, and on textbook is chapter 15. Okay, so it is debt financing is often considered less interesting than equity financing, right? But I want to know that actually debt financing is often at a larger scale of equity financing in terms of the size, right? In terms of the size. So if you look at the highest amount of debt issuance, right, meaning the corporate bond deals of all time, right? So this is a chart showing the highest amount of debt offering or bond issues over the history, right? So in 2013, Verizon was known to issue the highest amount, right, the largest amount of debt offering, right, that debt offering, which is about $49 billion, right, $49 billion of highest of all time. And then second, right, we have Actavis who offered, 21 billion dollars, right, in 2015, right, issued new debt to the market. Okay, so if you compare those figures to the highest IPO of our time, okay, documented as 2014, right? So this is all documented. So the debt information is documented before 2015, and the IPO data in the second graph on the right hand side is using the data up to 2014, right? So if you based on the record at that point of time, right, the highest amount of IPO, right, raised, the proceeds raised is $20 billion, right, which is about the second highest for the debt offerings, right? So in this case, you want to see that actually, on average, right, debt offerings is actually higher than the amount of equity offerings of all time, right? Compare with IPOs, compare with IPOs, right? So so if you have the impression that debt financing is not important, you're wrong, right? It is very important, and a lot of times it's even more important than equity financing. However, based on the nature of it, it's less talked about, and so people have the impression that maybe debt financing is not that interesting or not that important, right? So I want you to know that it is actually very important and a very important source for external financing, right? Sometimes the major source for external financing. Okay, so if you compare, right, the size of bond market and stock market, right, in another angle of looking at their relative importance, this is what you see, right? So guess which line shows the debt market and which line shows the stock market, right? So actually the red line shows the size, right? The size or the total market cap of bond market in the United States. And the blue line shows the total market cap for the stock market, right, for the United States, right? Adjusted, right? Both are adjusted by the GDP, right? So obvious, obvious, conclusion over here is that there's only for a very short period of time that the stock market's market cap exceeds the bond market cap, which is around the dot bubble, right? Which is around the dot bubble of 1999, right? Remind that from the last lecture, we learned that this is also the time when people are crazy about IPO companies, right? More than 400 companies get publicly listed in 1999, which is which sort of shows the market sentiment on stock market at that point of time, right? Everybody pretty much believed that they can earn a lot of money from the stock market, right? Which is why at that point of time, the market cap for stock market even exceeds the total market cap for debt, right? However, if you look at the trend, right? Another conclusion is that if you look at the trend for these two markets, you will generally, learn that the trend is increasing for debt, both debt and stock right? Stock market. However, for debt market, it's more smooth, right, than for the stock market, right? It's less volatile. Right? It's less volatile. You can think of this in terms of risk, that investing in bond market is relatively safe than investing in equity market. And if you look at the returns, they actually generate what is the returns, right? So if you think about investing in the overall debt market, right, the overall debt market, you realize the amount of money from $20 to almost $30, almost $40, right, in between 1988 to 2012, right? And look at the size. When you the size changed from $8 to around 20 to around $20, right? To around yes, to around $20 for stock market, right? To around $20 for stock market. Okay, so right, so the overall the takeaway is that stock market, although more people are interested in the stock market, right, doesn't change the fact that debt market is a more major source of financing, right? Major source of financing for companies. Okay, so corporate debt, right? So we're going to talk about corporate debt, right? We're going to talk about private debt, meaning that debt issued by private companies, right? And we'll talk about some examples of private debt, and we'll also talk about public debt and some important facts about public debt, which is basically corporate bonds, right? Corporate bonds. Okay, so debt is form of IOU, right? The borrower borrow money from the lenders, and it pays a lot of times it involves paying regular interest or regular coupons, right, to the lenders. And in the end, at its maturity, the borrower needs to pay the full payment to the lender, right? So private debt, right? A very simple example is bank loans, right? You as a private company, you finance your money, right, by borrowing from a bank, right? And the bank will charge an interest rate for borrowing, and you will pay the interest rate, or you pay the principal back to the bank at the end of this maturity, right? As agreed between you and the bank, right? So it's negotiated directly with the bank or a small group of lenders, right? And so the benefit is that it avoids cost of delays associated with SEC restrictions, right? So if you compare, debt with, private debt, particularly private debt with public debt, is that if you don't need to file those restrictions, and you avoid those costs of disclosing with the public or associated with those restrictions, right? So the private debt, in terms of its cost, is that it's less liquid, right? It's less liquid because they're not publicly traded, and it is often between a small group of investors, right? Small group of investors. So some examples of bank debt, of private debt, right? So bank loans, we have a different type of bank loans, right? So there are, is one type is called term loans, right? Which is the simplest form, right? So a form of IOU specified in a period of time, right? And there's something called a revolving line of credit, which is like a credit card, right? It's very like credit card that you have a credit line, and you spend money and you pay the balance at the end of each term, right? And if you fail to pay the balance, you get charged of the interest rate. And if you cannot, and the interest will roll, right? Will roll on as the time extends, right? So you better make sure that you pay the balance, right, on time, so that you're not charged, right, by the interest, right? So there's something called asset-backed line of credit, meaning that if you don't pay back your balance, and if you default on your loan, then the bank will have the right to take your collaterals, right? Meaning that for this type of credit, you actually need to show some form of collateral, show some form of assets, right, as a promise. Right, as a promise of your debt. So there's another type of loan which is called syndicated bank loan, right? It's kind of important concept, especially when the amount of loan is relatively at a large size, right? So feel free to click on the link here. There's a video about the example of a syndicated bank loan, right, which involves a number of banks as the lender group. Okay, and it is helpful for the banks to form together as a group so that they can share the risk and also provide more funding, right, for the company, right? So this is similar like a group of underwriters, right, underwriting the IPO firms, right? Sometimes the business is too big, too large, right, for one underwriter or for one bank to eat themselves, right? So they want to probably share the cake with some other players. So they not only share the profits together, but also share the risk together, right? So there's another example of a private debt is called private placement, right? Sometimes we call it private bonds. Okay, so it's a sort of like a private bonds that's issued to a small group of investors, which are not traded publicly, right? So compare this with a private equity, right? So also this is a type of investment with a relatively smaller amount of investors, right? So for those private placement, it is less costly to issue than public placement, than public traded bond. Okay, less costly to issue. Then there are not that many rules to comply, right? And under certain specifications of the regulation, this bond can be traded between large financial institutions. Okay, so it's basically allows investors to trade this with each other, right? So it's similar with private equity, right? Remember that the VC firms can do secondary buyouts, meaning that it can trade their shares of private equity of a private company with other VC firms, right? Similarly with private placements. And so this is like a picture for a bond certificate, right? At an earlier time, right? At an earlier time in 1893, right? So remind that the earliest example for equity, for public equity, is around the time of East India, right? East India Company, right? Which is a couple hundred years earlier, right? So also the history of bonds goes back to a long time ago, right? Goes back to a long time ago. In the earlier times, people who invested in the bonds are issued those paper certificates, right? And then they can redeem the value of this certificates at a specific point of time, and they can also trade this with other people, right? On each certificate, there's a specific number, a serial number, right? Which is unique for that certificate. And this serial number, right? Later on, we'll explain what this serial number will be used, right? It's unique for each certificate as sort of like ID for your bond certificate, right? For your bond. So there are many different types of bonds, right? So one type is called secured or unsecured bond, right? So there's a YouTube video, right? You can take a look and see what it means for secure and unsecured bond. But essentially, a secure bond means that it's sort of like asset-backed bonds, right? Asset-backed bond. It means that the bonds actually are backed by a collateral from the borrower, right? So let's say I want to borrow some money from you, and you don't know me, so you don't have much confidence in lending your money to me, right? So we can't just I can't just promise you with my word that I'll pay you back your money. So what should I do, right? So I'm gonna tell you that well, let's make a contract, right? So if I don't pay you the money, I will give you the asset that I own, for example, my car, right? For example, my house, right? So this is like how you borrow money from the bank, right? You typically need to have some collateral so the bank is willing to lend you money, right? In the worst scenario, if you cannot pay back fully, right, your money borrowed from the bank will take away your collateral, right? That's sometimes, right? That's one of the reasons why financial crisis happened, right? A lot of people buy the house and cannot fulfill their responsibility to pay it back, so they lose the house, right? So in financial crisis, right? So, but of course, it's a lot of the main reason is not it's not the people's fault, right? Who buy the house. It's the Wall Street people who make those packages and the securities, right? So to make the borrowing process too easy, right? Too easy for people. That's why it's called like subprime, right? Subprime mortgage, right? But that's sort of out of this topic, right? So what it means, right? What I wanted to say is that for secure bond, it's usually backed up, right, by a collateral, right, physical assets. And secure bonds normally will have a lower interest rate, right? Will have a lower interest rate. So in this case, the last thing, right? So instead of saying offers lower yield, right? The way to understand it is that sometimes it's related with a smaller interest rate because it's less risky, right? Because it's less risky. And there are bonds who is unsecured, basically. You lend the money to those companies based on their reputation, right? Purely by corporate credit, right? So this one will normally involves with a higher interest rate, and they ranks lower in the payment order, right? So what is payment order? It means that if you have different type of borrowings, okay, so secured bonds are often paid first, and so security bond holders are often paid first, and unsecured bond holders are paid later on, right? I'll pay it later. So for firms to issue bonds, right, it's similar with firms doing IPO, right? They need to hire an underwriter and go through a similar process of issuing the bond, right? So which we will not talk about in this class. But similar to the prospectus, right? Similar to the prospectus filed to SEC, right? For IPOs, the bonds also, right? Particular for bonds, right? It also needs to have a very clear contract, right? Very clear contract between the borrower and the lender, right? So in the contract, it will specify, like what is specified in the prospectus, right? It will show the information about the bond issue, right? How much is going to issue to the market, right? The total amount of money, right, of the bond, the face value, right? The face value. This is the amount of money that the borrower wants to borrow from the market, right? The date of issuance, the mature date, meaning the end of its maturity, right? The face value for each bond contract, which is normally $1,000, right? And if it's coupon bond, you want to specify the coupon interest or the coupon rates, right? So it's $100 per year, right? And the coupon days are, basically shows that it's a semi-annual coupon, right? Meaning that it pays $50 at the end of each half of the year, right? The offer price of the bond, the offering price of the bond here, 100 actually means 100%, right? Meaning the offering price is $1,000, right? 100 price of the face dollar, right? Or at par, right? At par. Yield to maturity is sort of like it's a return, right? It's return, or the discount rate you want to sort of think about, right? It also highlights the risk of investing in this bond, right? So there are often some other information on the bond, which is specifically related to different issues of a bond. Okay, so these trades are sometimes optional, right? Are sometimes optional, and the companies sometimes will want to specify those additional specifications on its bond contract, right? So one example here is what we call a call provision, right? So it means that the company can actually redeem or call back these bonds, right, from the market at a specific dates, right? So here is specified that after 2018, the company will have the right to buy back its bond from the market, right? And a lot of times it involves buying back the bonds of the market at a specific price, right, which is listed as a call price here. So the call price here is, it will call back. The company will have the right to buy back its bonds at 111%, right, which is 10% higher than its face value, right, before 2013. And after 2013, the company will have the right to buy it back at $100. Okay, so this is because the company wants to control the risk, right, for its interest rate. Okay, so because market interest rate will change, right? So the company issued bonds in 2003, right? However, it does not know what's going to be, right, for the interest rate in the future, right? Because bond typically lasts for 20 years, right? So think about it. if you're a company and you want to issue a bond which lasts for 20 years, right? Then interest rate will become a really high risk, right? Will become a really high risk for the value of your bond, right? Meaning that if the interest rate goes up, let's say, right, if the interest rate goes up, then the bond price will be smaller, right? Will be smaller. And if the interest rate goes down, the bond price will be higher, right? So in order to hedge against the risk of the fluctuations in interest rate, right, sometimes you want to specify this call provision, right, in order to take advantage of, when interest rate is increasing, right, your bond price is falling, then might be beneficial to buy the bond back at that point of time, right? So this call provision, right? We're not going to go into detail of this, of the logic between this call provision, but it's good to know that in the company or the borrower can specify some provisions in its bond contract, right, to protect it against the risk from interest rate. Okay, and it's defined by call provision, and the call price it defines in the specifications, right? And then it will list some other information about the trustees or the security, right, of the bond. And then finally, very important thing is about the rating of the bond. Okay, so let's talk about the rating of the bond because it's often what you see, right? A lot of the time you will see that some agency just raised or down, just upgraded or downgraded some companies ratings, right? Some companies rating, and this ratings is very important for company, right? Because it pretty much defines how costly, right, the company's debt is going to be, right, from the market. If you have a really low rating, right? If you have a really low rating from those rating agencies, like Standard and Poor, Moody's, or Fitch, which are the three largest rating agencies in the United States, right? So if you have a low rating from them, then typically it means that investors will believe that it's very risky to invest in a company, and they will generally expect a higher return from investing in a company, right? It means that on the other side, it will be quite costly for a firm with low ratings, right, to borrow from the market because they need to provide, a higher interest rate, a higher yield to maturity for their investors, right? So this is what ratings is about, and you want to know that there are different rating agencies in the States, and one of two most famous ones are Moody's and Standard & Poor's, and you want to know that there are certain what do you call this, right? Terminologies or certain signs of the ratings, right? So they normally start from AAA, which is the highest credit rating a company can get, and lower they have different signs, right? They have different ways of defining the ratings, right? After the highest rating, right? So for Moody's, they have AA 1, 2, 3. They have A 1, 2, 3, right? Different number of A's, and but for Standard & Poor's, they have AA plus, AA minus, sort of like how we give grades, right? They have A plus, A minus, and then was a B rating, right? So from A to B, everything from A to B is called investment grade, okay? Things that are lower than B, right, which start with a C, is called non-investment grade, right? Non-investment grade, and those bonds are typically what we call junk bonds, okay? Junk bonds, right? So how do we understand these junk bonds, right? So a lot of times the companies have a junk bond rating because they are downgraded, right? They are downgraded from a higher rating, okay? For those ones, right? For those ones, we typically call it fallen angels or call it distressed bonds, right? It means that they actually existed as an investment grade bond, but has fallen to a poor rating because they have suffered from distress, right? Financial distress, right? It's a valid company. It's a valid company with valid businesses. It's just because they have borrowed too much, so that investors are not as confident as before in the ability of that companies to give back the investors their payments, right? So those companies are generally believed as, described as fallen angels, okay? Companies used to be good, but later on, get a lower rating because of financial distress. And there are other companies who are, in the first place, right, given a very poor rating, right, below the investment grade rating. And those bonds are what we call junk bonds. They're normally, from the companies who have very risky operations, very risky operation. And sometimes they're just, companies with bad businesses, right? So think about Kodak, right? Who used to be a very good company, right? But because of, the technology development in cameras, right? They do not have a valid business anymore. And it's not like they're doing actually something that's, that makes sense right now, right? So those, that company can be sort of think as a company that issue junk bonds, right? Who doesn't have a very good business to if you think about it, right? So the fact of the returns, right? The general returns from these two type of companies is that distressed bonds generally, right, or the fallen angels of generally perform better than the junk bonds, right? Generally perform better than the junk bonds. Okay, so that's sort of the understandings, right? Because they're essentially the good companies with valid businesses, right? Think about AMCs, right? So AMC probably have been downgraded by a lot because of COVID, right? But before COVID, they have a really solid businesses, which is the theater businesses, right? And hopefully, if the COVID has gone, right, people will return to theaters to watch movies, right? It means that they have very good businesses in the beginning, right? But have been downgraded because of certain market shock and because they don't have good businesses right now, and they suffer from high leverage, right? So this type of companies will generally have a better performance, right? The bonds from those companies will generally have a better performance than the junk bonds. Okay, so I want to talk a little bit about covenants, which are some specifications the borrower can actually list in the bond contract, right? So you can think of this covenants as the requirement of the bondholders on the issuing firm. Okay, so this is kind of weird. Why would an issuing firm actually make those requirements for themselves, right? Make those limitations for themselves on the bond contract, right? So the reason is that those contract actually assures the investors to buy the bonds, right? Makes the bonds more popular among the investors, right? Because you can rest assured that the companies will have to follow those covenants, will have to satisfy the requirements during the maturity of this of the bond, right? So think about this requirement in two ways, right? The first way is that it can be it could be a negative or sort of like a restrictive covenant, meaning that the covenant actually prevents the company from undertaking certain activities, right, which can potentially hurt the bondholders, right? For example, a negative covenant, an example of negative covenant is that a firm cannot issue any new bonds until the current bond fully matures, right? So what does that mean? It means that in the process of during the maturity of the current bond, right, the company cannot issue any new bonds or cannot increase its leverage, right, until this bond has matured, right? So this is actually beneficial to the existing bondholders who hold this bond, right, because the firms will actually limit its risk, right, of going bankruptcy, right, because it cannot issue any new bonds, right? So this is an example of negative or restrictive covenants which actually benefit the existing bondholders, right? An example of a positive or affirmative covenant is that it could be that the company wants to maintain a certain level of cash until the bond matures, right? So it means that this is a requirement for the company to do something, right? To follow certain standard, and in this example, right, to keep an amount of cash is beneficial for the existing bondholders because having cash in the pocket of the company assures that the payment can be paid, right, to the bondholders by the company, right? So this example of a positive or affirmative covenants. right? So as opposed to the negative or restrictive covenant, right? So from these two examples, you can see that sometimes it will be both beneficial for the borrower and the lender that some covenants are specified in the bond contract. Why? Right? Why? Because essentially it can lower, right? Essentially it can lower the cost of borrowing, right? To issue bonds with such covenants, right? Think about it. Bonds with these covenants are less risky than bonds without those covenants, right? So investors will be willing to take a lower yield to maturity for investing in bonds with such covenants, right? On the other side, for companies, issuing bonds with covenants is cheaper than issuing bonds without those covenants, right? Than issuing bonds without those covenants. So those covenants actually lowers the cost of debt for those companies, right? So there's actually a benefit for companies to obey those covenants, right? To issue bonds with those covenants, right? So, but the cost is that sometimes it limits what the companies can do, right? Sometimes it limits the amount of risk the companies can take, and particularly because equity investors will normally sometimes like to take risky projects, right? Because if you think about this, equity holders will have a different incentive with bondholders, right? Bondholders will typically want to receive standard payments from the bonds, while equity holders actually takes the profits, which is the remaining amount of value that are left over from after paying the bondholders, right? So sometimes if the company is only engaged in safe projects and generates less revenue or less profits, then it's not best fit for the equity holders, right? So sometimes equity holders will want to take risky projects, and the covenants is sort of like limits the amount of risk that equity holders can take, right? So here's an example explaining, right? So the firms makes $1 million interest payment every year to debt holders. Let's suppose this is the case, right? The company has borrowed money from the investors and needs to pay this amount of interest payment to the investor holders. And there are two states of the economy, right? So there's upstate and downstate with an equal likelihood, right? So if there's a project that pays 1 million profits on upstate and 0.5 a negative, right, $0.5 million in the downstate, then a project B pays 2 million profit on upstate and negative $1 million in downstate, right? Which project would equity holders pick, right? So think about it, right? So project A, right, has a better, right, expected return than project B, right? So 0.5 times 1 plus 0.5 times negative 0.5, which will give you a positive net present value, right? Net present value. And the second one, it pretty much increased the scale, right? Increase the scale of the cash flows. But it's a less preferred project than project A, right? So you will see that project B actually has a higher risk than project A, right? Based on our knowledge, our knowledge on the calculation of standard deviation, right? So in theory, investors will prefer project A than project B, right? But think about it. If equity holders decide to take project A, then it can only generate as much as 1 million profit, right, on the project. And the 1 million profit will all be paid to the debt holders, right? The 1 million the 1 million profit will all be paid to debt holders, and the equity holders will be left with nothing, right? If it turns out to be the upstate, right? However, so this is the reason why the equity holders will actually want to take project B, because they will get something left on the upstate, right? So B is a more risky project than project A, but would be more preferred to equity holders because project B on the upstate will actually give some profit for the equity holders after paying $1 million to the bondholders, right? So this is the reason why sometimes equity holders would prefer the more risky project because it gives some potential for the equity holders to actually have something left, right, to pay them, right, to put into their own pockets, right? So in this case, right, project B is preferred because there will be likely no residual cash flow from project A, right? So in this case, equity holders will prefer to take risky project instead of a very relatively safe project, right? So, and then, this, if the company has such covenants, then, bondholders will be protected, right, from, equity holders' incentive to take risky projects. So that the risk amount, the amount of risk on its debt will be smaller. Right? So there are different type of debts, right? So senior subordinated debts, right? So you want to know that senior debt ranks higher than subordinated debt, meaning that the holders of senior debt get paid first, and then subordinated debt get paid later, right? Here is a graph showing the recovery rates, meaning that the amount of money actually get paid back to the debt, right? If the debt has been defaulted, right? So let's say the company went bankrupted, and the debt payers get to be paid with the remaining value of the company, right? Who gets to be paid first? The holders for the senior debt, right? And then the holders for the subordinated debt, right? So here, from the top to the bottom, it shows that the amount of money will actually get paid back to the different to the investors, right, who invest in different levels of debt, right, in terms of its seniority of payment. Okay, so we have. Well, I want to make the impression that we want to understand that debt is very important in terms of the market size, right, relatively to equity, and also you want to know that on top of the corporate debt, right, we also have a tremendous amount of treasury debt, right, treasury bills and treasury bonds, right, issued by the federal government. Okay, so where to find bond information, right? There's an agency called FINRA, and here's a link for you to find bond issued by different industries, right, by different companies, right? If you're interested in investing in bond as sort of like a safer investment relatively to stock market, right? And here's a summary between the difference between debt and equity, right? And compare different perspective between these two. Okay, so this is everything I want to talk about bonds, and in the live session we will do a review of bonds versus equity, right? Do a review of public and private bond and debt, and hopefully we can get a better understanding on external financing, right? So in this topic, in the external financing topic, we have less calculations, right? However, we have more concept, right? More conceptual and more logic, more theories to understand on these two type of financings, right? So it is very important that we make sense of different type of investment channels and different specifications in the issuing, right, and in the understanding of the contracts of different assets. Okay, so I'll see you in the live session. Bye bye.